And on today's show, what is premium financing? Part one of this week's series on premium financing using Index Universal Life with premium funding strategist and attorney, Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Robert.
Thanks, Steve.
Robert, I have to say, I think it's been a little while since I've had anybody on in the last 4 years on premium financing, and I think people think that this kind of got set aside after the debacle of 2008 and 9. Premium financing kind of went the way of the dodo. You say, no, this is really hot now. There's been a huge revigoration of the market. Talk to me about, and I just want to set the record straight right up front, recourse or non-recourse?
Definitely fully recourse.
So fully recourse. Nobody's doing non-recourse anymore.
Nobody's doing non-recourse anymore.
Now, when you got into this, why did you get into this kind of premium financing? I know you really liked it before, but the product didn't work right. How did you invent this in your mind? Because really your methodology, all this week we're going to be talking about it, is patent pending and copywritten.
Well, really, SFI was a response to premium financing and all the problems that you just alluded to in 2008. The idea of SFI was to actually reduce some of the risk of premium financing. And so the goal here was to figure out a way to create an earlier exit strategy and to reduce some of the risk of borrowing. That was
okay,
that was
now
the
when
goal.
you use the term SFI, it stands for?
It stands for self-financed insurance.
Mm-hmm. Now, when we're talking about reducing the risk, you saw a pretty large risk by holding out a loan for such a long time.
That's correct.
And you figured out a way through a methodology and an approach to reduce that timeline. Now, if I understand your methodologies, because we're going to be spending some serious time on this all this week, you're only talking about a 10-year period. Is that true?
That's correct.
Well, talk to me. How did you settle on that timeline?
Well, that turned out to be the sweet spot. Mm-hmm. My goal was just to take the exit strategy down to as soon as I possibly could. And it turned out that 10 years just happened to be the sweet spot.
So if I went to an institution and I cleared their prerequisitions, I'm sure there's a lot of prerequisites here, and I cleared that, and am I making the interest payment every year?
Correct.
To the bank or institution? Is that correct?
Correct.
Okay, so I'm letting it ride. Now, I know you've tested this and back tested this. How did your methodology work? If I was to use like the lost decade as an example, because we had 4 out of that 10 years, there were actually S&P 500 losses. How did it work under that stressful? Because if it works under that, right, it's going to work under anything.
Correct. Well, what happened, even when we stress tested this model under periods as bad as the lost decade, what we found is that in our worst case scenario, we were still able to pay off the bank loan in just 10 years. And the policy was still able to continue. It didn't perform the way we obviously would have wanted it to perform after that, but we were still able to pay off the loan on time. So our worst case scenario wasn't as bad, and the risk was manageable.
Now, of course, there's 4 different mortality chassis. We were only using one of them. Only indexed with arbitrage loans works in this methodology. Is that correct?
That's correct.
Okay, so later on this week, we're going to walk you through some of the not only case examples, but some of the mortality mechanics so you can understand why this works and why we really can't use par whole life, current assumption UL, or variable.
That's correct.
Now, let's walk through some of this. When I think about this, there's the pros and the cons.
Right.
Why don't you give me the pros first, because I always like to do the positive first.
Well, the pros of premium financing in general is that it's generally less expensive to pay for a life insurance policy by paying interest rather than it is to pay the full freight of the premiums themselves. So from a cash flow perspective, interest is less expensive than premium cash flow. The second advantage of premium financing is that even if a client has the cash on hand to pay the premiums, economically speaking, it may be more cost effective to pay interest because interest rates are so low right now that from an opportunity cost perspective, it may make more sense to borrow money than to give up what he's earning on his investments.
And can I ask you this, Robert, what is that prevailing rate right now?
Well, it's generally in the 2 to 3%, interest rate area, LIBOR plus some kind of a spread.
So it is LIBOR is the baseline?
Usually they're LIBOR-based rates in the larger case market.
So you're arbitraging the interest rate rather. Why should I not just pay interest, annual interest, rather than pay the full premium?
Correct.
Okay.
And in many premium financing designs, not ours really, but in many of the typical premium financing designs, interest can be rolled up into the loan or accrued. So these things can be very flexible. The client can often decide how much interest he wants to pay out of pocket, if any at all. And so it's very easy to get into a life insurance policy because it's inexpensive, or it seems inexpensive. But the downside of all of that, and if we go to the next slide, is the downside of all of that is that as you accrue interest, obviously the loan balance gets bigger and bigger and bigger, and it becomes more and more difficult to get out of the loan because now you have a large loan balance that has to be paid off somehow down the road. And that's really where the durational risk becomes a problem, because it becomes hard to pay off.
When we come back from the break, we're going to continue with Robert Strauss, and we're going to talk about some of the basics as we introduce you into premium financing, kind of updated for 2015. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance, designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with attorney and fund strategist. I love that, funding strategist, Robert Strauss. Robert, let's walk through the three basic premises, because if you don't buy into this philosophy, then we should, you'll not want to watch the rest of the shows. So let's talk about leverage first. Why is leverage so important? What's the economic value of leverage?
Well, it's very important to try to keep the leverage of premium financing, and that's exactly what we're trying to do. And that just basically means using other people's money to fund the premiums. And by that, I mean we're going to use bank dollars to fund the premiums, just like a typical premium financing program. The only difference really is that we're going to pay off the loan quicker. And what leverage simply means is that every time the client makes a small interest payment out of pocket, the bank is going to make a large premium payment into the policy. So economically speaking, that provides more bang into the policy, more economic power into the policy.
Okay, so I'm thinking if I'm showing, let's say, give me one of your prevailing rates that you use in IUL. What is it, 6 crediting method? What
usually high sixes. So
okay.
Let's say 6.9.
Okay, 6.9. So if I'm at 6.9 and I'm looking at my internal rate of return on a traditional proposal, I might be netting, when it's all said and done, I might be, after expenses and everything during distribution, I might be at 5.85, or if I'm using arbitrage loans, maybe even more. But now I'm adding a new leverage issue, so my internal rate of return is going to go up higher because my actual out-of-pocket is interest rate, and this is what you're teaching with leverage.
Correct. So the client actually has a lower outlay, but there's still more working for him in the policy because we have other sources funding it.
Now, you use a second thing that you talk about here besides leverage. You say arbitrage.
Correct.
When you're talking about arbitrage, I thought when I first saw this, I said, oh, isn't this arbitrage between the interest rate and the premium? You said, no, this is arbitrage on the loan.
Correct.
Talk a little bit about that.
Well, the original idea when I created the concept was to use arbitrage in order to pay off the loan quickly. It wasn't really designed to enhance the performance of the product. It was simply designed to pay off the loan quickly. So when I tapped into the policy early, remember the goal here was to create an early exit strategy. So by paying off the loan early, that generally hurt the policy. So if you take for example, a withdrawal in the 10th year, that would kill the policy. If you take a non-participating policy loan in the 10th year, that would kill the policy. Even a wash loan ends up causing the policy to expire in just a few years. The only way to take a loan or a withdrawal or any kind of distribution from the policy that quickly without hurting the policy or creating friction or drag on the policy is to do so in a way where the crediting rate exceeds the policy loan interest rate on average. It doesn't have to do it all the time every single year, but on average, so that it doesn't create drag on the policy.
All right, so and let me make sure I redux. So that tells me I can only use indexed UL, universal life, and I can only use indexed universal life that has the participating loan feature.
That's correct.
Now let's go one step further. Variable or fixed loan?
Well, very, very important, because there are two moving parts to creating arbitrage, obviously. We need a crediting rate that exceeds the policy loan interest rate, two moving parts. So we want to control that as much as we can. So if we can fix one of them, then we have much more certainty and much more comfort that we can provide to the client. So we have no control over the crediting rate because we don't know what the equity markets are going to do. But there are products out there that will fix the policy loan interest rate forever.
Wow, contractually guaranteed?
Contractually guaranteed
and
forever.
What's a number? Give me a number that they're using now right now.
Well, today you can lock in at a rate of 5% for the life of the contract.
So if I make 8, I'm making 3 on that deal. Is that correct?
So if you have a crediting rate of 8, you can actually have a spread of 3, or a crediting rate of 6, you can have a spread of 1. Now, that policy loan interest rate reflects what the insurance company is making on their overall portfolio. So that is not necessarily going to be something that is going to be offered forever. It's kind of like a fixed rate mortgage. You can lock in right now to a fixed rate mortgage at a very low rate, but if you wait 5 years, who knows what fixed rate mortgage rates are going to be. So this is an opportunity that people have to create arbitrage conditions that are very favorable, and those conditions may not last forever.
Let's talk about tax-free benefits. Now, this is something that most of our audiences are going to know. The traditional issue has always been withdrawals to basis policy loans of gain, as long as you keep the contract in force for the life of the policy insured.
Correct.
That's what we're talking about tax-free. But we're not even talking about withdrawals to basis in this scenario. Is that correct?
No, generally we're talking about policy loans if we're trying to create income or death benefit, tax-free death benefit under Section 101.
Okay, so when I take this money out at the end of the 10th year under your methodology, patent pending methodology, I take that money out. I'm taking out as a policy loan.
As a policy loan.
Okay, so I might want to capture withdrawal space maybe later in life, in the life of the policy, but not for that.
Correct.
Okay, so 3 different ideas here that seem to have aligned. It sounds like the planets aligned on this product. I have the leverage of paying interest versus premiums. I think I'd rather pay less. I love the arbitrage, right, that you're talking about here between the loan feature. If I exceed the fixed loan cost, which you said right now there's many carriers that are about a nickel. And then this last one, of course, is the tax-free benefits that we've always had with life insurance. Wow, it sounds like all 3 have aligned perfectly.
Correct.
Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.